Well, what do you think about what we've seen in the US market's performance this year?
Oh, I think it's been nothing but outstanding when you consider where we started the year, Steve, to where we went in March to where we are today. I think it's just been a Herculean effort by the market to actually kind of push away all the uncertainty in the past few months that we've seen and start to look forward. And I think the real question that we're seeing is, how much forward are we actually looking and how much forward are we actually building into the markets today?
And yet, David, the point I was trying to make at the war, and I'm sure you share these views, it is very uneven, of course. You have some sectors which have been left behind and may be left behind for a very long time to come. Sectors that potentially, if we thought we were going to have economic growth and that the economy was going to power ahead as well as the markets, would have come with it as well. So what about the unevenness of this market? Does that lead to dangers for our viewers?
Oh, for sure. So I think the way you look at it is we went from a risk on trade, which we had at the beginning of the year with extremely low unemployment, pretty decent nominal growth. And we went into obviously COVID, which took us to a complete risk off scenario in March. You saw many other hedge funds as well liquidating and trying to raise cash, not knowing where the world was headed. And then, within a few months' time, once we saw the Fed liquidity pour into the system, once we saw governments attempt to get ahead of things and stimulate the global economy, I think that, along with the fact that things are recovering from the virus, I mean, things aren't becoming much worse from what we've seen early stages of the virus. And when you put all that together, we're back into a risk on mode. The question really, how I look at it though, is we're in a risk on mode. We're back up at highs. We're actually up on the year, like you said, for most indexes. The Nasdaq's up, well over 20%. The question is, where do we really go from here? And is this sustainable at this point?
Yeah, and that's a great question. And I'll just throw in another asset class here as well, because despite the fact that the abundance has returned to certain parts of the market as well, it's also returned to some of the risk-off trades as well. And we've got gold pottering around $2,000 a troy ounce. Now, if we thought that the world was going to be a safer, economically growing place going forward, we wouldn't necessarily be saying that gold is going to go much higher from here. But you think it could well do, don't you?
Yes. So, Livermore, we've been bullish gold for 2 years. And as you know, Steve, I mean, we're focused on very specific value oriented companies. And, so we've been investing in energy companies, financials, and obviously material companies too. So we looked at gold 2 years ago, in fact, when it was hovering around 1100. And again, not looking at it from the metal itself, but just looking at it from the standpoint of so many of those companies, the miners were so blown down. You had things like Barrick Gold trading at $11 a share, and a number of the smaller junior players, which Livermore is more focused on, including there in London, which were just left for dead. So you fast forward today, you have gold prices now almost over $2,000 an ounce, potentially on its way much higher, and a number of those stocks have done extremely well. So it's helped us in the past 2 years, and I think this is just still the early innings. So at some point in time, you're going to find out who's right and who's wrong. Right now, every single asset class is going up. You have bonds going up. You have stocks going up. You have technology going up. Like you said, certain levels of the economy are not still doing well, and those stocks are suffering. Gold and miners and metals are doing very well. And I think at some point, we're going to find out who the true winners are and who the true losers are.